the hijack era, we all have to change the way things get done. And it's very similar in accounting. As problems occur, we have new rules, new regulations. So this is something that we need to look at in how we understand accounting. So don't think of it as something in the book. It's something that happens every day. Now, I know we ask you to do things like read the newspaper. Do you get asked to do that by other teachers in your courses?
Well, you just do it each day. That's
You
whatever they ask.
Good. Okay, so you keep up to date.
Yeah.
So I just happen to read the newspaper on the weekend, Financial Review. So it's a good newspaper for anyone who wants to be an accountant. Okay, you want to be an accountant? Yeah. You're studying accounting, you probably do. So this is all about finance and financial news. And any time you pick up a newspaper, there are stories in there. And you should be thinking, how does this affect me? How does it affect accounting regulation, accounting practice? Now, even on this front page, there's a few things. First of all, there was a big story on the weekend about Lehman Brothers. You remember a US bank, one of the big 4 US investment banks. They went broke in the global financial crisis. And in Australia, we had a decision made by our courts, Supreme Court, that Lehman Brothers was going to be found guilty and have to pay compensation because the information they had used to sell securities to various purchasers, in this case government agencies and buyers, was misleading. So this is a really good story about accounting information. And what you need to understand is when we talk about accounting regulation, there are many parts to it. So we're going to have a look through all of the parts of accounting regulation. So understand that the law is really important. So this is a legal thing about Lehman Brothers. There's every likelihood there'll be an appeal to the High Court. But this is important because this is a test case, a global test case. The first time anywhere in the world that a court has made a ruling on the Lehman Brothers collateralized debt obligations, CDOs. These were financial instruments that were issued by Lehman Brothers to investors, signed off by auditors and accountants and investment bankers and credit rating agencies, saying that these were good securities. They ended up being worthless. People lost lots of money, and now there's an opportunity perhaps to, we'll see how this plays out, because I don't think it will just end here. It will no doubt go to the High Court. I'm sure there'll always be an appeal. These are very complex matters. There'll be lots of lawyers, because the money is very big. They're talking about millions, billions of dollars. So it's big stakes. People will spend all day in court talking about it. Now on the very bottom of this page, in small red writing, you can read, I'll show you, it says, I'll read it out, it says, CBA pearls are equity dressed up as debt. See that? Okay? Again, these are financial instruments. Financial instruments. These were issued by the CBA's Commonwealth Bank of Australia, one of our big banks, big 4 banks in Australia. And part of their investments, they sell securities to investors. And one of the big questions we have as accountants is what are the financial relationships in a balance sheet. So why is it important if something's debt or equity? Why would that matter? What do you do? You did do financial statement analysis a long time ago. What's the accounting equation look like? Who can do this? First year accounting. What's the accounting equation? I'll have to remind you. Okay, your assets equals your liabilities plus equities. What's the relationship between, we call liabilities is our debts, so debt, equity. We've got a debt-equity ratio, pretty common ratio. What does that tell us? What's the debt-equity ratio normally tell us?
we foreign say?
Pardon, sorry?
We foreign say we.
If you've got lots of debt and not much equity, what would you say about this company?
No, we're in debt.
In debt, well, what does that mean? How do you interpret
They
that?
don't generate enough of equity for this problem.
No. It's not about generating, it's high risk, risk. The number one word in the world, okay? We're all worried about risk, don't we? So we normally go debt, equity, and if debt's very high, so we have most of our assets are financed by debt, by borrowings, we say that's equal to risk. Okay, that's our key measure. What makes an investment risky is if you borrow lots. Now we know in the case of Lehman Brothers, and they do lots of fancy accounting. If you want to know why these companies play around, and exactly the same, Commonwealth Bank, exactly what Lehman Brothers did, they play around with these things. If we can pretend we can shift stuff up and down here, we've got the same assets, or we may even fiddle around with our assets, and I'll talk about that in a minute with Lehman Brothers. But what the companies do is try and play this game here, moving things between debt and equity. That means if they can move more stuff from liabilities, actually treated as equity, that is going to reduce their risk. They have more liabilities, more debt, it becomes more risky. Why? If we look at the asset value, say we have 100 here, 100 million, 100 billion, whatever number you want to put, and we have 50 plus 50, that's pretty normally considered very conservative. Okay, very conservative. But what happened in the global financial crisis is that a company like Lehman Brothers had this kind of number, 95 to 5, or even higher, maybe something like about 97 to 3. So everything is tied up in debt. All their assets are financed by debt. What happens if the asset falls in value? Only has to fall 3%. Very little. They're wiped out. Okay, that's what happened. So even say their assets come down, we have a financial economic crisis. Assets say go to 80, 20% write down in assets. We got 97, and so what we got minus 17 here. Plus minus 17. Okay, so the shareholders all wiped out. Company goes bankrupt. Okay. So what else could happen? What happened in Lehman Brothers? Well, it didn't happen in Lehman Brothers because they didn't get bailed out. But what's happening in Spain, Portugal, Greece? All of these countries now have banks that look like this. They have negative equity. What happens? How do they get saved?
From the European Union, they just give money banks. But it's
Okay.
nothing at all.
Okay, well, it doesn't. Maybe that's another issue. But
Yeah.
what this means and what happened in Merrill Lynch, Citibank in America, this negative stuff. The government comes in. Who's the government? The taxpayer. Okay? So you and me generally, we are paying all our hard-earned money to save these bankers. Okay? They've all spent all their money, got themselves into debt. Okay, so the government gets involved. We've got money coming back in to buy up some of these troubled debts. What happened last week is probably not on the front page here, but you may have read, you've been reading newspapers, what happened in America last week or so?
No, they just in so much debt, like everything, what to say, the property prices went down, and everything is in banks because they don't actually own anything, like people
Yep.
are not owning, so they cannot pay it out because inflation is higher, and
Okay, that's part of it. But specifically an event happened last week in America. You know the central bank in America, what it did? The Federal Reserve Board, it's called Federal Reserve Bank of America. You know what they did last week? You heard of quantitative easing? This term, quantitative easing? So the Federal Reserve Board in America, Federal Reserve Bank, is now buying mortgage-backed securities from the banks. They've gone into the QE, what they call QE3, quantitative easing 3. It's the third phase of basically creating new money to help grow America's economy again. Again, we've got mortgage-backed securities, which are, most banks are secured. The assets of the bank are all the loans they've given out. That's their main asset, and they're secured against property. A lot of those are worthless because the asset values have come down. So the government buys these up to prop up the bank. And they're doing that. $40 billion every month. And Ben Bernanke, who's the chairman of the Federal Reserve Bank, said they're going to keep doing that for as long as it takes. Not going to stop. $40 billion every month. Buying troubled assets. So this is the sort of issue that underpins accounting regulation. Okay? Why do we have regulation? Because financial markets get into trouble. Okay? We can tell the story over and over again. The good thing about it, you are students in really exciting times. You feel that? Really exciting. All the stuff every day. There's
happening.
billions
Frauds and frauds.
all around you is problems, and it's newspaper, headlines, TV, internet. You can find everywhere stories about financial crisis, economic crisis. Okay? Which is very interesting. It's good for you as students because you can learn all these things. Learn all the games that they play. So I talked to you a little bit about Lehman Brothers a while ago because they happen to be in the news. And they have really interesting practice. They have many interesting practices, but they're no different to many things that have gone on in the past. So what Lehman Brothers used to do, they've got this accounting equation here, and they had, for example, a balance sheet that looks something like that. So that, it might be, is into billions or nearly trillions of dollars. So they've got huge amounts, maybe in their asset side. Lots of these things. But every quarter, what they did is they had introduced a thing called a repurchase agreement. Or for short, a repo. So this is a financial instrument that Lehman Brothers created. They were the masters of financial innovation. And so when you read about Commonwealth Bank making up some hybrid financial instrument, whether it's debt or equity, it's all about these kind of games. Accountants are really creative people. Are you creative? Are you creative? You think you are? Will you be a good accountant?
After reading such news, you just become great.
Yeah, you make Pablo Picasso look like he was just a baby. These guys can make anything disappear, magic. So what did Lehman Brothers accountants do? They had these repurchase agreements, and they said every quarter we want our balance sheet to look better. How would you make your balance sheet look better? What's a quick way to make that balance sheet look better? Less risky. How would you make it less risky?
Employee equity.
Okay, yeah.
Employee profits.
Okay, you could. There's lots of ways you can paint this balance sheet. Okay, your one is to increase equity and increase profit. But that's not the balance sheet. Profit's in the income statement. You're going to make profit anyway. You're a good accountant. Don't have to worry about it. You want to just make the balance sheet look better. So you've got to change these numbers here. What could you do? Decrease liability, okay, that's very good, okay. So we can decrease liability. You were going to say something too?
You told it already.
Same, you're going to both decrease liability? You going to do anything, Naringa? You want to make the balance sheet look pretty.
Yeah.
Less risky. How? Okay, we want it less risky. So we want a better debt to equity. We want to get this debt to equity ratio down, don't we? Okay? That's the aim of the game. So you're a creative accountant. So we had this thing called repurchase agreement. So what the bank did, it's basically what you guys are saying. You're thinking, right, we didn't worry about equity because we're not going to put more money in because we're smart guys, you know. We're going to make more money. Why do you have low equity? Why do you do this? Why do you have this highly levered, highly structured thing in the first place? This is where your profit comes in. Okay? Let's assume we've got 10 of profit.
Review expensive and
Okay? We've got 10, so we've got $10 of profit. What's the measure you're going to look at here? What are your two key measures that you're going to look at for profitability? You know, return on investment, ROI? ROE, you know the other one, don't you? Okay. So, what's our return on investment in this one? $10 profit or 10 million or 10 billion? We've got 10 billion profit and 100 billion in assets. We get 10%, aren't we? What's our return on equity? 200%, is that right? You guys are pretty, you're the smart guys, aren't you? Okay? You have a low equity, don't you? Because if you've got 5 billion in equity and you've got all this gearing, then the return comes back to your shareholder. They are the primary return. They don't want to increase equity because they're making great profits. All the banks, keep in mind, all the banks were making great profits as long as the markets kept going up. Okay, so we don't want to change the equity. We'll just leave that there. But what this repurchase agreement was doing, said how can we get a better, what's the problem here? We've got 10% return on investment. We've got $100 billion tied up in the market, only getting 10% on it. How can we make that look better? This is
invest more.
No.
No, you don't want to invest more.
You want to be creative accountants, okay? So we can say, okay, that's our numbers. What ones can we muck around with? We figured out we can't, well, we can muck around, we can make any profit up we like. We're good accountants, so this number could be anything. But we just say that we'll keep it at that level. This one we don't want to muck around with, so we can only muck around with these two, don't we? What can we do? We can get rid of some of our assets, get rid of some of our liabilities, repurchase agreements. So we get rid of all these. So what Lehman used to do, every quarter, get rid of 50 billion out of there, 50 out of here, sell them off, but repurchase them the next day. Okay? So our balance sheet then looks like 50 equals 45 plus 5. Okay? Less risky balance sheet now. We've now got 20% equity. Or 10%, sorry, 10% equity, sorry, in the business. So it's less risky. This is what the repurchase agreement did. They sold these off to the market with a binding agreement to buy them back 3 or 4 days later. So every time the financial year ended, Lehman's got rid of them. After that, they're called repurchase agreements. They buy them all back. So that 2 days later, they're all the same. Now, the auditor comes along. At this point. Auditor auditor of the big accounting firm, Pricewaterhouse, Coopers, any of these big accounting firms. They come along and go, this is the balance sheet. Oh, it's all good, very good. Good balance sheet. This goes to the financial markets. Lehman Brothers is a great company, getting good returns and less risky. Okay? Then, unfortunately, when the global financial crisis came, they couldn't do this anymore. Couldn't make these tricks. And of course, all these mortgage-backed securities out here, instead of having 100, they might have only had 50, but they've still got 95 here, wiped out. And the US government said, we're not coming in to help you. They were the only bank let fail. And of course, nobody knew that this 100 billion or trillion of dollars was all over the world. In Iceland, in Ireland, in Australia, in China, in Japan. Every country had bought all these because these were AAA rated, AAA, high security. The auditors ticked them off. Credit rating agencies, Standard & Poor's, Moody's, Fitch, these kind of guys, ticked them off. Great. Okay? That's what happened. Creative accounting. So, what are you going to do? You're now the Prime Minister of the country. What will you do? You've got a new job. You're not an accountant anymore. You're the Prime Minister. You've got who's upset? Who's going to be talking about this to you? Who's going to be on the phone? Anybody going to ring you up? Send you an email? You're the Prime Minister. You expect to get lots of phone calls? Maybe you get a bomb threat too. I don't know. They go, hey.
Where's my money?
I worked for 65 years. I'm a pensioner. I've got, all my money was in here, AAA rated. I've got nothing. I'm homeless now. I'm just a voter. Then you might have another person saying, oh, I run this government agency. We've got no money for the next 10 years. We can't help any children. We can't run schools. We can't have parks or gardens. You're the Prime Minister. What are you going to do?
Increase tax.
You're a good Prime Minister. You'll be kicked out next election. Nobody will vote for you. Can't increase tax. Okay?
Badly you can.
You can try it, but many voters will be upset, won't they? What do you do? You want to try one? You're the Prime Minister now. What will you do? You're not going to increase tax, are you? You're going to blame somebody else. You should blame.
Yeah,
You
who was
go.
checking them? Auditors.
Yeah, let's go and kick some accountants, okay? We want to get these guys kicked.
Who gave us AAAs to
These
them?
guys are bad accountants. Bad accountants. Okay? They're going to go bad guys.
Okay, they use that creative accounting. They just adjusted to how they, for their own benefit.
Yeah, well, the
So-
bankers, you're going to say, oh, these bankers are bad guys. They shouldn't get paid so much. Because what? Keep in mind, these bankers are getting paid all this based on this profit here. Okay? Oh, we want a big profit. The bankers take home bonuses, lots of money. Even when they got bailed out, they got home lots of money. Lehman Brothers bankers in their derivatives department were allowed 50 billion of bonuses out of the troubled asset repurchase from the US government. Because the bankers said, oh, we can't work if we don't get a bonus. We don't work. There are only people in the world who won't work without a bonus. They couldn't work. So the government said, oh, here's all this money you can take as a bonus to help you through this difficult time. But that's another thing. You need to have a good president, like President Bush was around before Obama came in. He said, oh yeah, you can have a bit more money. Your poor bankers, you only got $50 million last year in your paycheck, or $300 million. Who?
If you give the bonus to the bank, the funds will come from to the public.
what will come? Sorry, I'll just explain a bit more.
If the government has no money,
Mhm.
that's the power.
Well, the government can always have money because the government can print money. Unless you're Spain or Greece.
Yeah,
Because
make
then
the inflation go
But
skydiving.
you can just make the money up. Governments always make
Oh,
money
no
up.
way.
They do, all over history.
Let's not do Somalia.
Everybody makes the money up. No, the money is not a problem if you're a government. You can do two things. You can tax the people,
Yeah.
or you can print more money.
So
Two
better
choices.
tax the
Very easy. Okay? And governments, they've got to balance it a bit each, you know. They'll tax a bit and then they'll cut a few of their costs and things like that, like they're doing in Australia now. Saying, oh, we've got too many workers. We'll
Yeah,
make
they
people.
legislate 14,000.
So these are the games that, but if you're the government, what I'm saying, if you're the Prime Minister or the President of your country, and all this is going on, what happens is you want to be in control. Oh, I am going to be the, you know, able to save the country. This is what's gone on. We need to have more regulation. We need to fix this up. Oh, there was a problem here. We can get the auditor. We have better regulation. Have more regulation about this. We'll have more regulation about these things. Generally, whenever there's financial crisis, governments respond by creating additional regulation. That's what happens. They may go into the accounting area, into the governance, into the executive remuneration. A lot of regulation now about executive compensation and remuneration. All these things go on, and then it goes, oh, after many years of inquiries, committees of inquiries, this is what ends up. We get a new Companies Act, new requirements and the regulation. So this is the background to what we're going to talk about today. So you understand the context? Okay, it's very live. And but this thing happens all the time. Economic crises, corporate crises are not new, they're not just happening today. We started companies about 160, 170 years ago. A modern corporation was established. And every 5, 10 years we have what we call an economic cycle. The economy grows, expands, we get a bubble, then there's collapse, there's more regulation, expanding, collapsing. This pattern goes on, and we can trace that. Now the one that we are dealing with right today is described as one of the major economic events for the last 70, 80 years. In the 1930s, we had a major economic crisis, often referred to as the Great Depression. It affected many countries around the world. And that was seen as a bigger event than today's crises. And today we have a lot more skills and resources and knowledge about how to manage countries and economies than we did back then. But even so, this is a major event. It's now been since 2007-8 when the crisis started to unfold. We're now into our 5th year of, and what happened is initially this crisis was on corporate balance sheets, particularly in the banking sectors, but it affected many other companies outside of banking, and it transferred across more recently to governments, because governments assumed a lot of the debt, and so we now have a crisis in government finance around the world, in many countries, particularly the Eurozone. So a major crisis of confidence in the financial balances of companies. Now we had this a few years before. We had a tech bubble, you may remember, you're probably all young. Just to remind you, in about year 2000, we had, during the 1990s, a big bubble, and we called the tech bubble, and the tech boom and bust. And that happened around 2000, 2001. Then we got the big market freeing up of liquidity, and a big bubble in securities, and particularly in mortgage-backed securities in real estate, particularly in the US, but it happened pretty well all around the world. But they were the ones that uncoupled first. Before that, we had an Asian currency crisis, 1997, 98. Speculation over government debts, particularly in Thailand, Korea, Malaysia, Indonesia, these kind of countries. Before that, we've had booms and busts. We've had mergers and acquisition booms. We've had booms about commodity prices. We had an OPEC oil crisis in the 1970s. So every time economic systems or parts of economic systems get out of balance, we get a crisis, we get a response to crisis. And that response is normally a form of regulation. Okay? So that's the big issue. Accounting regulation is nothing special about it. It's part of a regulatory package. So what we need to do is think about how it all fits together. And that's what we'll look at in the next little bit, trying to put some accounting theory around it. But keep in mind, at any time when you are looking at things, make sure you can take it back. When I tell you to be a Prime Minister or you're going to be an advisor, what you should be doing in this course is developing your analytical skills. Your ability to say this event is occurring, this is how it will have impacts, and you can then give advice to people. You may give them advice to the company board of directors, you may be giving advice to auditors, you may be giving advice to a government minister, anything. Your job, you're finishing this year? You're doing MPA?
Yeah.
MPA, and you'll all be graduating soon?
Not soon.
Not so soon. Oh, hopefully you'll graduate sometime. Then someone will say, oh, you've got a good degree. I want your knowledge. I'll pay you a big salary to give advice, okay? That's what you should be doing. So what I want you to aim for in this course is to develop your skills so you can take all of this stuff that's in your textbooks, in your course notes, in newspapers or wherever, and Craig Deegan, he puts lots of examples from newspapers, be able to say, what does this mean? How can I tell someone about it? Oi, that's no good.
Yeah, it always does it. 12:30.
Does it? It's the time of day. So what are we going to do here? Press this button. Let's hope it all starts up.
Ian, you press the computer. There is a button
Yeah,
in the
press that
screen.
one, but nothing seems to
The computer.
computer display. Well, maybe it'll come on soon. I tried that one, but it